Hi. The other two ratios that we normally discuss in the for the return is called return on capital employed. These as all the assets that we have discussed are financed by either the company's their own equity or by the loan. So we call it total return on capital employed. So out of total current assets, the company may have some working capital, some current liabilities. The rest of it has to be financed by the company's shareholders and either from the loan. So the company may have capital employed. So to calculate return on capital employed, we use earning before interest minus the taxes. Means what is the income which is available to the company's providers of capital. So the company's provider of capital are two, shareholders and debt owners. So they are earning usually the dividend and also the interest, both, right? So we have to calculate the total earnings together with the interest. But since the tax is not used, so in EBITDA usually you will have EBITDA is before the taxes. So what we need to do is we need to calculate earnings before interest less taxes, and that will be using for calculating the return on capital employed. So we will be looking at the real calculations in a bit. The other aspect of this return ratios is called return on equity, which is usually the most used most used formula in probably corporate history. There usually also the goal of the corporate finance managers to maximize the return on equity. So return on equity is calculated by net income divide by the book value of equity investment, or for listed companies it also can be calculated by market value of equity investment. If you calculate in traditional accounting terms, it's calculated by book value, because that's usually the book value is the for so that the balance sheet is tallying. However, in the practical sense, for investment purposes, for valuation purposes, return on equity is calculated by net income divided by the market value of equity investments, not by the book value. So there is a slightly different conclusion. For accounting ratio analysis, we'll use book value. For corporate finance purposes, which we have another class, is going to be the market value of equity investment. Now let us look at what are the implications of this two calculations and how do we calculate them. So coming back to the same example that we have already discussed, let's say this company has being financed by equity, company ABC, equity, debt and current liabilities. So how we will calculate the the return on capital employed. So first is we need to calculate earnings before interest minus taxes, right? Since we don't have the taxes here, we can just use net income plus the interest, right? That's the net income. Again, the similar way, because depreciation is non-cash item, but for our theoretical purposes, we will let them include there, because the net income which is available to the company is earning before interest minus the taxes. Since we don't have taxes, we have this income available to the shareholders. Now, what is the return? What is the capital employed? So capital employed usually would be equity plus the debt, right? Long-term debt, not the short-term debt. So the capital employed usually is your equity plus the long-term debt, or you can also calculate this by using total assets minus the current liabilities, because that's what is the total current assets. So that's how we will calculate the capital employed. So what is the return on capital employed? So ROCE is going to be 3000 divided by 9000. So that's what is going to be the ROCE, return on capital employed, right? And return on assets, return on equity. Return on equity was the calculation was net profit divided by net profit divided by the total capital, total equity. So the return book value of equity. So here is the book value of equity. So here you are calculating the return on assets. So you can see now Return on equity is high in case is super high for compared to company A, is higher than return on capital employed. The reason being is because whenever your interest rate, so what is the when you are comparing this, whenever your interest rate on the debt is going to be lower than your lower than the return on the assets, the return on equity will always be higher than return on capital employed, because it will improve the margins, right? So here return on, so average interest in on interest on the debt is only about 0.25%. I think I have calculated it on a wrong formula. Yeah, sorry, this is should be on the debt, not on the total. So let's calculate on the debt, not F5, F4. Yeah, so here you can say the we are calculating interest at 5%, right? But return on assets is over 30%. So in which case, if you take a debt, then what will happen is your equity will go down, since your return on asset is much higher than your cost of debt. Your return on equity will increase, so there will be a significant difference. In the higher debt you take, the higher will be the investment. So here in this case, company A, the gap is much higher because it is taking a loan, it's taking a current liabilities, the equity value is lower. There is a difference here, so let me fix that. Yeah. And in the other cases, when you have the return on equity, return on capital employed, which will be similar, if you don't have the debt, then capital employed will be similar. Let's say they have a less debt, but compared to this company which has higher debt, the difference between the return on equity is going to be increasing. Assume that you are paying an interest of more than 30%, well, which is not really the correct way, but we can assume for hypothetical purposes. So let's say we are paying a return on asset on 34%, 35, or let's say 40% per year, right? 50% per year. So what will happen is return on equity will tend to go down compared to return on capital employed, because your debt interest, the interest on the debt is higher than your return on assets. So whenever it's go higher than the return on assets, it will always be better to finance through equity. But if your interest rate is lower than your return on assets, means you are able to generate much higher return compared to what you can finance outside, you should use the debt, you should use the leverage in order to increase the value for your equity shareholders. So that's the implication of equity shareholders. Another way, another yardstick you can use always is return on capital employed. So if your interest rate is you can use this return on capital employed in order to evaluate, in order to gain more debt and also expand into your business. If any project is going to give you a higher return compared to your return on capital employed, is going to be profitable, means it will improve your return on capital employed and also return on equity. So return on return on capital employed is used as a hurdle to check sometimes the additional investment opportunities, and return on assets is usually used as a hurdle for checking the interest rates if your or financing options. If your financing is cheaper than return on assets, is better to finance. If your project is going to give you more than your return on capital employed is already there, then it will be a better investment. So it may help to capture the choose the evaluation capital investment decisions. So that's the ratio between the two, return on assets and also on return on equity and return on capital employed. So in the next video, we are going to discuss a couple of case studies in the real life telecom industry, so that we can explain you how these ratios work in real life industry, rather than the hypothetical example that we have taken just now.